All right, good morning, everybody. Thank you very much for joining. The What I've done here is I am going to yes. So I'm going to talk about a couple of things here, right here at the beginning here. This is the agenda. It should be shared here on your screen. I'm sure that it is actually. Yep. So we're using Zoom here today. I'm not going to necessarily stick with it, but for today, I think very good. Let's improve the sound here a bit. Okay, so what I've got, I'm going to talk briefly here about United Healthcare. So I've not made comment about it. I've made one comment, which is I don't believe in vigilantism. Right. But I think that what it does really tell you is the following. I'm going to put it here on the screen, right? Which is the real failure here. The real failure here is that this person failed in decoupling, right? And it goes to show you how complicated healthcare system is in the United States, which is I am empathetic to the idea that this particular case, this person was having a health problem, a big one, right? I don't have a great back. I can tell you that my own situation, I'm not debilitated by any means or limited, but I'm just saying it's like I wake up, it's like, boy, my back is sore. But what I'm going to share this here, which is this Economist article. And I agree with some of this here, but really not to show his picture or anything, but this is this graphic here. Right, is that people don't understand financial contracts. They don't understand that health insurance is a financial contract. And now then from there is the jargon inside. And now you can see here that the alarming degree to which people do not understand how complicated it is. And the issue here is that this is not the uneducated, right? I mean, this person went to the University of Pennsylvania in engineering. This is not, right? This is not Joe average student that you find on the street. Absolutely not. No way. No way. Right? You don't gain entry here. You don't study engineering at very difficult school here. That does not occur. This is, spitting different distance to Harvard, very absolutely the case. Absolutely the case, even if you're not involved in academics. Right, so their business school is Wharton, the second best finance school in the United States. That's a tongue-in-cheek slam. Anyway, but really what I want to point out here is that, throughout the Jay's Corner, my number one thing here is to try to decouple. And decouple is the term that I hijacked, and that's why I shared the link to my this tab here. You see this? Where is he? Ooh, not here. Nate Silver, well known for being a political analyst here. That what ends up happening is, let's just see. This is the book. This is his new book. And in here, right, he's giving this term called decoupling. And I like reading books and seeing what other writers and communicators do so that I can try to improve myself. That talking about decoupling, not merging. You don't know about something, so you merge it with this topic. This is what this person did. I don't understand how health insurance works. I don't understand how healthcare delivery works. I need to find, right, that's over here. I need to find someone to blame. It's over here. which is to me just it is a single case study of this ongoing thing when it comes to money. Right? I clients that do this all the time, all the time, and the educated. This is not because the person is uneducated. This is just a natural thing that occurs in the world that people try to solve their lack of knowledge over here with something to find someone to blame over here. Wrongly based. And so, of course, and then you see that this woman in that this person here, yes, the copycats come out. The copycats come out. This person here, then on a recorded line, on a recorded line says deserved karma from the world because this person over here says that she went on a recorded line to physically threaten Blue Cross Blue Shield of Florida. And we're not going to solve that. I get right. I'm going to lose the war. I tell people in private conversations, it could be with you, that I'm going to lose that war. Right? I'm losing that war because I'm just a guy. I'm just a guy trying to make this clear, to clarify these types of topics. The fact of the matter is that healthcare delivery system in the United States is so complicated that I cannot you could take one side, I'll take the others for sport. We'll get into an 8-hour debate. We'll be stuck at the same place. And it's not going to matter what your starting point is. It really is not. That what we're going to do is end up, and one of these things here is pointing out this, is that the tree are hardly the only villains in the story. And this is why I agree with, you may know, Financial Times, The Economist, right? They are non-American press with very good, I would say, writing. And as a result, very qualified to kind of not be overly biased with partisanship, right? They don't have they have no stake. Healthcare profit margin is about 6%. Most insurers make less. Apple makes 25%, and by no means. And so now you can see very, very easily. Somebody then says, well, healthcare shouldn't be for profit. Okay, you've not decoupled. That's a different topic. And right away, you can see the very easy example, right? The natural thing to say is somebody then diverts this comment here to, okay, healthcare is not to be for profit at all. Okay, you're talking about philosophy of government in American life. That's an entirely different set of books. Thucydides now coming, right? Hobbes' Leviathan, Karl Marx, right? Adam Smith. Those are the books that you need to refer to solve that pushback reply to this statistic. And again, this is not the uneducated that put their hand up in this way. It is the educated people who have put their hand up in this way to me. And now you see this 26-year-old young man, terrible situation, terrible to the victim, of course, that, and that's my point, is this is not just to some bumpkin. It's not. This is not a bumpkin. This is the educated. This is the high IQ educated. He should have known better. He's mathematically not challenged, right? Engineering graduate. This is the mathematically, qualified to decouple. Didn't do it. So it's our main takeaway, really, to be candid with you, because you can see now that all of these other topics everywhere on the channel, every newsletter, every topic that I talk about is like, okay, let's keep separate stuff separate and then proceed. And let's just go on. So enough on that. 2025, 2023, 2024 is a very strange combination of years, right? Back to back, higher than 20% on equity markets. But I want to go back just one step further because some stuff still persists. People to the newsletter understand, newcomers, I continue to say stocks for show, bonds for dough. I understand that stocks get all the attention. It's easy to understand what an Apple iPhone is. Apple iPhone is a scam. I say in jest, right? Innovations that are 2 years old at 30% premium to the market, and getting able to get away with it, you're a scam. Anyway, and I'm only kidding, right? The more power to you if you're the seller. Bonds for dough. What to think about inflation, cost of everything. So I've discussed this 2 years ago, and so now the good thing about the internet is you get a time and date stamp. This is the very good video. It's probably my best of the, and of course, this is, a compliment to Art, which is, he swerved. He started talking about economics at this time. We were coming out of the pandemic. And what I have been stating everywhere on newsletter prior to this dated date. What is this dated date? This is 2 years ago. This is actually I saw the date. It's April of 2022. And here I said the following. It's probably still not fully realized. So it's probably still not fully realized. What I was saying was that the higher interest rates and the higher inflation at that time were not fully discounted in asset prices, and that had lagged. We got it. This is the S&P from basically around the time that I made that comment through the rest of the year. Right? We are not getting away ultimately, so you can understand my point. There's a difference between strategy and tactically. Strategy is about function and structure of markets. Structure. I've already discussed this here, right? This is a year that during the time that GameStop came out and there were hurricanes in Florida, and I'm talking about here, this is the technical way that portfolios are actually built, right? Not am I diversified on, mad money. That's more annoying because Jim Cramer is the educated. But he's out there for views and clicks. But the fact is the step skipped is this entire process. The reason that I bring this up is that is what I've been showing you here when I talk about I will be able to swerve to it easily. So let's just go to Mr. X portfolio. Here it is. Right down over here, I'm measuring here and just showing people, hey, there, for example, just as 2 line items, and have other been places on the newsletter, these tickers, which basically represent Vanguard and BlackRock's version of these, which is the default position of 401ks at most of the employers, right? So depending on who their suite of selections is. They're using this technology, Vanguard, BlackRock, and there will be every other large carrier or, producer, if you will. Fidelity has their own, Schwab has their own, American Funds has their own. on and on and on it'll go. And they will be different versions, variations, but make no mistake, that's your theme. For the people who are far better than me at, or and far more educated than I at finance, or at, not at finance, but at underlying mathematics, this is a linear algebra exercise. This is a linear algebra optimization exercise. And what I've been saying to people is, it ain't likely these guys are wrong. This is over, what I did is, and just gives you an idea, which is probably the most crazy thing. From the end of 2022, I took these snapshots. You can see by these numbers. Since then, I did nothing else. I just left it there. Over that year, from then to today, they differ by 0.1%. On $100, they're different by 10 cents. Nevertheless, people are telling me, okay, diversified portfolio, I cherry picked this stuff randomly and, I did it myself. Well, guess what? Unless you did it using this way, you're running against the grain, against all of the way the rest of the entire planet runs the largest pools of money in the world. Right? Government Investment Corp of Korea, Temasek Holdings in Singapore, Taiwan Central Bank, Swiss National Bank. They're running some kind of version here, twisted, CalPERS. They're running some version of this twisted for their specific situation. And now I'm giving you insight on what the comprehensive financial planning service that we run is, right? I call it the air quotes stable. The people in the stable get this for their specific situation. So in other words, CalPERS. Let's just take that as a simple example. CalPERS and CalSTRS running this. Well, later in this video, what do? I'm showing you something that looks like this. Let's just see if I can get there. And I'm not going to play the video, but I'm just going to show you what was being shown on that video. Come on. I'm using up so many resources. Anyway, what it does is showing you the asset class grid. Right? In other words, and maybe you can see this little picture here. That down over here, what I've done, wow, is that it's a grid of asset classes. And the grid of asset classes, their access to the asset classes is not yours. Right? In other words, on another video, I've talked to Ann Lester, who was one of the pioneers, JP Morgan Investment Management, creating their own suite of these. My colleague as an education fellow at the Alliance for Lifetime Income. I'm very sure she's right? In other words, we were talking about, here it is. So you can see here, and we don't even need to drill down on what the headings are. Stocks, bonds, cash, commodities, alternatives, private equity on these axes. And then we've got covariance and correlation grids. You can understand everything that I've said over the past 5 minutes. If you want to, people ask, how do I tell if my advisor knows what they're doing? You simply ask them the following question. Explain to me the key inputs to creating a diversified portfolio. There are 4. Expected return, expected volatility of those returns in that asset class, covariance, correlation. If those 4 terms don't roll out first, you have an issue. Because that means, for sure, For sure, if they cannot easily say those and explain to you in some terms what they mean, that means they don't know how this is built. And if they don't know how this is built, this is what you get exposed to. Why? Because one of the key things here is this correlation that this thing breaks down. This grid breaks down during times of duress. Correlations break down. And now you can understand why that at the end of this year, of the 2022, you had averages of IRAs minus 17, 18, 20%. That means there were 100% stocks because their definition of what diversified portfolio wasn't, and even that it wasn't this. And you can see this is me showing a thumbnail to a video that I made prior to the video that I'm sharing with you here. Where are we today? Where are we today? The issue here is that inflation here is being a lot stickier than they had hoped, right? That the Fed has hoped, right? And so as a result, the ripple effects that are notable to me. Number one of those, and I will share it with you now, right? Which is that let's just go and just make a couple more rows above. Number one is, something called the equity risk premium. The issue here is, are you paid enough? Boy, sorry about that, everybody, to buy stocks. Right? You already have an allocation. Do you add? You need another buyer in order for prices to go higher. You need another buyer for prices to go higher. Okay. So what's the equity risk premium? So ERP is the equity risk premium. And we're not going to, I'm not going to give you the full primer on equity risk premium, right? But you can see it here. And we'll just, this thing is now negative. Is the extra return for taking extra in stocks instead of risk-free for securities? Right? And you can see it here. So the question is, am I being paid enough? Well, the risk-free rate is higher and stickier. That's my point here. So once you get so this is the strategy, right? And it kind of leaks down here, and maybe we're not even going to talk about that point. The ISRI is now negative. And now we got the issue. Because who's paying attention to this? Oh, the people running these. You bet. And so now the question, and we have started to see it. Maybe. Let's get away from, this is 2022. Let's just take the last month. You will see here notably flatter. Notably. Once the assumptions of a new president spiked to here, we've seen flattening here. Once the euphoria, where's the extra buyer? And to give you an idea, this is RSP. So the algebra of the way that you're given information, right, is S&P 500 is a market weighted, right? So that means Apple gets a higher percentage of the calculation of SPY. S&P 500. What this particular security does, RSP, and I'm using it for not for recommendations, this is not financial advice, but what I'm doing here is I'm showing you this illustration about what happens if you reduce the idea of market cap weight and make them all equal weight. And you can see here that that blue here is down. So what really has happened? So now we've got some kind of strange, not strange. It's not crazily strange, right? That what has happened here is what has dominated. This is strategy, but tactically, and so I will tell you this. So strategy is about, do you understand how this works? And this does dominate. Over long periods of time, this dominates, no question, right? How are you handling this? When you were 30, this you surfed this curve slightly differently, right? Why? The runway is longer when you're 30. You're now 55, you're now 60. The runway is shorter unless you have found the elixir of life. As a result, you've surfed this curve slightly differently. And now all the other topics of Jay's Corner, right? Roth IRA, tax efficient, asset location. So what does end up happening here is that now what I'm saying here is that this is the strategy, and this now is the tactically. And by tactically, what tactically is tactically equals the short run. And by short run, I mean short run-ish. I'm not talking about day trading. We're going to talk about day trading a little bit later. Wild down here. What's going on down here? So what you have is now tactically now flattened. And this is not getting the attention as it is over here on Twitter. Okay, because over here, I'm still going to call it Twitter, and let's leave out Blue Sky for now. But Twitter has professionals. You don't know who they are. You may not, you'll look on somebody's profile and you won't be able to distinguish the everyday person. And by everyday person, that is not some people take that as like me being condescending. No, what I mean is you're not from the playing field of the largest investors on the planet where I first, my original home. That's it. That's not Acme Wealth Management, sorry. But my point here is over here, yes, there are people pointing this out, that tactically this is now flattened. This now becomes the challenge. It's not all bad. That the other stuff still attractive. This means life insurance. This means annuity, long dated CD, whatever you want to call it, right? Because the rate has been stickier than markets may have discounted in the past. Okay. There is a market neutral prediction of the future, and that's the forward rate. You'd have to look that up on Jay's Corner or look that up somewhere. I did explain it. And I realized that there's a lot of different terminology and topics that I'm winging around in, but the point is these are interconnected, right? What do you want to be like? Jay's forward rate corner? It's not going to work. So you can see these other things are, and as I explained, literally just to anyone who will listen, interest rates still the minestrone soup or the soup base to every variation of minestrone soup. thus bonds for dough. Bonds for dough. That's what I would say here as far as the strategy goes. I will say I'm going to move this here because I'm going to make a last point over here, which is the investment strategy side. So I'm going to include this up here, right, which is central bank versus central bank. Well, if you asked me what keeps me up at night, why did I look at August and tell the stable, look, we're going to adjust here? Because the world got told a new term called yen carry trade, which you have seen on the broadcast that I've made, yen carry trade. That was real. And the reason it was real is because it was this. This. Do we have it here? We do have it here, I'm sure of it. Saw the article here today. This is it. And here's the issue. Last point on strategy. This one. This is the kind of thing that keeps me up at night. Central banks making zero-sum moves. Is that what would explain much of the 2000s up to this date, until the pandemic, is one-way train, lower interest rates in a coordinated fashion. Period. That's it. If someone had told me that interest rates would be one-way train in that way, if you had that crystal ball, not too tough. Not too tough, right? Find the risky assets, buy it, that gets the overweight, put it into the coffee can. Why? Interest rates lower. Okay. And why is that? Of course, right. As most people know, they've seen some variant of this here on the newsletter, right? Denominator lower. The end. That's it. Another variant of bonds for dough. When this stops working, in other words, the issue here that I'm pointing out here, that I'm highlighting here on the spreadsheet, is central bank versus central bank, because I've pointed out to you here that yes, interest rates down in a coordinated fashion. And when interest rates don't go down in a coordinated fashion, the issue is the glue holding two interest rates together is foreign exchange, right? So this is the key principle here, which is you may just think, oh, euro weak, that means that, my vacation to Italy is on sale. That's true. That is true, by the way. I tell my frequent travelers, what are we doing? Time to go, right? Everything is on 15% sale. True. There are more than 10%, I should say. While that's all true, what I'm saying here is that when this interest rates start moving around in different directions, the glue here is interest rates, and that is a problem. You'll see it here. If we go here, and this is investing.com, I've shown it many times. Whoa. Whoa. 110 to 105, and that's just since August. 113 to 105. 120 to 105. The issue here is that if you are living in Frankfurt, you are by currency alone, right? Your purchasing power of your euro is lower. Your national stuff is lower. This is an issue because if you keep extending it, the only way to increase your euro value that you know Marcus Detweiler in Frankfurt is buying is to increase interest rates. And this is my point, is that you're seeing, and this is the point of what that Bloomberg article is here. Wonder if we're going to be able to find it. Central bank versus central bank. That's not for today, but it certainly affects, it is part of the landscape here. Okay. So fairly tough stuff here, right? But 2025, right? Because the other things are known, to be candid with you. I'm not interested in what's known and commonly accepted. Yes, our regulations, our regulatory restrictions on business going to decline? Yes. Did we know this a month ago? Yes, we did. Did we know it 6 weeks ago? Yes. After one night when we found out that, someone didn't understand the assignment and she lost like what, 60% of like Latino men? Forget it, you've lost. You didn't understand the assignment, you've lost. It was easy to come to regulatory restrictions are going to decline. That was not complicated. But that means that everyone knows this. We won't talk about efficient markets hypothesis, weak form, strong form, from my ex-professor who got a Nobel Prize for it. That is not what I'm saying. But if the everyday use is like, look, everyone knows this. It's already in the price. Therefore it stops being interesting. Because it's in the price today, right? If you knew for sure it's going to happen tomorrow, you buy today. Well, you just keep extending that. Okay. On smaller types of things here, smaller-ish. I did. I'm going to go through these faster. I do have an announcement on Medicare. ACA premium spike higher and what to do now. There's no doubt. I've stated that I promise you that these recordings are not, me to talk to myself to say I told you so, right? It's not me having a crystal ball. It really is not. It is understanding how the pricing works, that the dynamics in the pricing have changed, etc., and what would then be the only rational conclusion. So what looked like a crystal ball prediction isn't, which is more a statement about the fact that we have a knowledge crisis about how it works, how it's built. Right? This is just the one that gets people's attention because CNBC is on 24/7. Underneath here, health insurance. And when you have a problem with the knowledge of it, of course, you get this. This is too big an extreme. To people on ACA, to people who are trying to surf for ACA compliant, I'm just going to tell you that everyday people are making it worse. Some person who may or may not be a client in the future commented to me that, well, you sent me some information that wasn't useful. I'm like, I saw what you were clicking because it's saved on our save screen. I'm like, you're off by $500 a month compared to the efficient choice that you would possibly make for 8 months. So you put your pride of I can do it myselfism and cost you, and we're going down a path that would have cost you $4,000. To me, I would rather get some better information on how the innards work. Keep the $4,000. And the reason I say that is that the other day, for example, I got this. And I literally got this, is that I've got a 60-year-old self-insured, $210,000 of taxable income. Now, congratulations to this person, right? Congratulations to this person that they have the earnings power to make $200,000 self-employed net of expenses. But my first reaction is, and then I said, okay, well, do you realize that this means net of all of your expenses? Couldn't you have handled your accounting better? Taken more expenses to push down your taxable income, on which depends the ACA, right? And so, of course, obviously, the thing I like most about, if I have to say, as most people know, I don't like video because I have to look at myself. I don't like podcasts because I have to hear myself. I don't like writing because I have to read myself. Anyway, I'm that person. But anyway, here's the point, right? Which is this article here, my research note. It is the singular one that you should share with people, 100%. Because people don't understand this linkage. I said, okay, how'd this happen? Do you understand that you can take out expenses? Now report back to me. And the answer I got is, my financial advisor says this is the best we could do. Let me just say, without seeing a fact, I find this very difficult to believe. This person lives in Timbuktu, right? This person does not live in South Beach, doesn't. That if self-insured, could I have planned to push this out so that where the brackets are higher for IRMA, which are notably higher later for IRMA, but no, somehow, right? And you can see it here. The stunning mistakes I see is just, when you see angst, you hear angst in my voice, that's what it's from, right? But you can see it here. These brackets are a lot higher. On the ACA, this is dollar for dollar at 8%. This person lives in Timbuktu with a terrible health insurance state, very uncompetitive. So poor insurance at high prices. And by poor, I mean payout structure costly given the angle of the convexity of your long options position, just in case you thought that you could just do it yourself. I find this statement here very difficult to believe. And the reason I say that is because that person doesn't know about this. That the ripple effects here onto this paper, right, this isn't for my benefit. This actually is, and we're having some latency problem, but the point of this is that this is back to, me showing these things again about decoupling, this is the situation where you've decoupled, or you've presumed that these are different topics when they're not. Health insurance, both Medicare and the ACA, are tax-related matters. Why? Because the healthcare system is a tax-related matter. Because why? The uninsured are paid by the insured. When somebody doesn't have an insurance, they leave the unpaid bill at the doctor's, at the hospital. Guess who has to pay? You do, the insured. So that acts as a tax on the entire system. Therefore, it makes logical sense that this is a tax-related matter. Conceptually, that is correct. Absolutely consistent. Very elegantly stated when the Supreme Court ratified the ACA. Wormhole of why people, the opponents to the Affordable Care Act, were so wrong. They took a toothpick to a nuclear war by saying, okay, it's unconstitutional. The sitting president is like constitutional, like scholar. You know, just because you didn't like him and, it's Obama's fault. Academically, that was his resume. What are you doing? You took a toothpick and brought it to like a nuclear war. Said, okay, well, like complain to the Supreme Court. This is, like, as a competitive matter, I don't know what. Seriously, this is terrible. Don't get me wrong, these aren't flowers for the president at that time. President Obama also sold something that was a tax matter as if it's health care. So, okay. Please don't make this worse. This means also to people that you know. They're making it worse. And the key year, and I'm going to here's the most important thing I'm going to say probably of this. I buried the lead. The most important year, the year you are planning on changing jobs or retiring. The year, oops, left out a word. The year before. So we're now December 14th. If you think you are going to retire in 2025, this is the most important period right now. Why? Because Roth conversion, Roth IRA contributions, for example. And why is this important? Because the value of what sits in the Roth is much higher. And why? Interest rates higher. So now you can see that while I said that decoupling is I started, I've now said, look, one of the weaknesses here is what you thought was unrelated are exactly related. And if you want max net worth, right? If you want max net worth, that's not the right spot. Where is it? If you want maximum net worth down here, you're taking into account all of these items here at the same time. Right? Ultimately, that's what I am doing. Right? I'm explaining these interactions to that end, with that as the end. Like, for example, like long-term care insurance today, I don't, as a base case, recommend it. Why? It's not because of its function. It's because of its price and the maneuverability of the options price and its effect of here. And whether or not there are other instruments at different price points which can fulfill the same function, even if not as robust, in order to create those payment structures, and also simultaneously doing what? Trying to maximize this line. The only one that really matters once adjusted for your utility. That's a different topic. Different video. Okay, we've gone at high speed. 50 minutes. 10 minutes. Am I going to be able to cover 10 minutes? I don't think so. Let's see here. Last point down here is going to be, oh yes, Medicare. This effective 2024 effectively ends free advice, unfortunately. Yeah. And so I have to walk very carefully here. So basically what has happened here on Medicare is that carriers are not paying at all on MAPD on certain Medicare Advantage or Part D. I believe, as many people would know, right? I'm here making this video, right? I believe in doing the right thing. You're a client, you get the razor's edge. That's it. I don't know any other standard, right? Ignoring entirely the relative compensations of, option A versus option Q. I don't care. What I care about is peaceful sleep more than anything. But the problem here is when the compensation is zero, the issue is I still have regulatory oversight. Right. This by itself, in certain cases, I'm happy to do. I've done it. I've already been doing it for you, whether you know it or not. I just have not told you. But now what has happened is this is that so many are not paying. And so basically what happens is now you're Mr. Nobody or you're Mr. Entitled in Timbuktu. And you think that I am a financial person, with this pretty t-shirt on and, so you file a complaint, which is your consumer right to do so. I've broken no rules. You don't know what the rules are. You just don't like it. You're Mr. Entitled. I called you Mr. Entitled for a reason. I've got to drop all my other work when I'm getting paid zero, literally zero. This is a balance that no rational person, this is a combination that no rational person does. None. What this means is that only paid subscribers are entitled. I'm simply going to not answer emails if you're not a paid subscriber. I'm just going to say we're closed. And this is terrible, right? Because that means that there's going to be one exception, of course. You're on Medicaid. I consider I was telling somebody, I consider probably 25% of my time to be pro bono, volunteerism. Okay. So as unsavory as that is the unfortunate landscape. And you can see it here that they're going to be, oops. There it is. Right. Decision to cut commissions on Medicare Advantage plan, et cetera, et cetera. Several major, not small ones, by the way. These are major ones. It's not, Jim Bob's Insurance Company Part D in like 3 counties in, Alaska. No. We're talking about the major ones. And now you can see that all I've done is astronomically increase the risk. which is fine if I'm 27 starting out. That's the risk I have to take to get up and going off the ground. I'm sure my colleagues at the Alliance for Lifetime Income would rightfully not be very comfortable to know that that Mr. Entitled is throwing a mud ball. Those are actual like smart people in the Alliance for Lifetime Income, right? Ex-chief economist of Social Security Administration, you know. All right, and then there's me. um, let's talk about Bitcoin here. We're going to end it here. So, Bitcoin notably higher, obviously, for those of you not up on current events, right? For those of you not up on current events, Bitcoin notably higher. And this is the 1 year chart. Going to show it's going to be from 40 odd, to that's too long. Yeah. So the low of 40 to 101. And so now a number of different financial principles first, right? People says, okay, there's no asset backing this. There's no asset backing the US dollar, which is a piece of paper, or the euro. So it's not really gold. Hard asset. Okay, well, I have a piece of metal. Does it have some other actual use? The only thing it has is that you have physical possession of it. Right? And so I reject basically all of that. The question is here now what? So I would tell you a couple of things. That the macro, I'm going to deal with it this way. The macro remains. Right, that while the micro looks like crazy, and it has been very, very, you can see here that the catalyst of the perhaps, which is not confirmed, but we can make that backwards induction. Pretty sure I've abused that word. So since the election, you're talking about from 70 to 101. So about 40%. So it had been my view. So a couple of things. Number one is you can see some pretty strong bouts of down here, and this is just this is the last 6 months, as you can see. I'm going to review it with you. You can see from down here, 68 area, all the way down to 56. So you've had to be able to bite your lower lip if you like the volatility. The issue here is that, why? But and by macro, let me just point out a couple of things. Number one is, right, sorry. Still uncorrelated. Fits on the curve. So you can remember at the beginning of the video, right? And then the grid. Right? That certainly commodities, for example, fit on this grid. Perhaps. Crypto, a new entrant onto the grid. Yes. And as a result, you're not getting away from that it does fit on this curve now. And this security by itself has done it. So this particular security is the ETF of Bitcoin. BlackRock doesn't own the Bitcoin. They don't. They're the holders of it in the ETF. The owner is the owners of shares of the ETF. How you have on TikTok that it's BlackRock's fault of the real estate because they own all the... No, they don't own the stocks. They own they're warehousing the shares on your behalf. You're the owner of the stocks in the ETF. Crazy. Anyway, Again, I'm going to lose the war. So, but what they did is they basically gentrified Bitcoin. They gave it a qualification by its stamp of underwriting the ETF and standing behind it for its place on this grid. And as I started today, who's on this grid? Oh, the largest investors on the planet. What does that mean? That allocating in here tells you why the macro here is going to remain. We're not getting away from that. We are not getting away from that. Tomorrow, for example, we will not have a world where where BlackRock says, okay, just kidding. We're going to liquidate all the Bitcoin that we own in order for the IBIT show and send you the money. That's not happening. Okay. On top of that, and what we do not have yet is, so IBIT has done it. I think that that is very clear. The other thing that is that the the largest investors are still not on board. Not yet. They're looking at it, yeah, no question. But my point here is the amount, and what I've told other people is that, privately, you've seen like these bouts, and these are not trivial, by the way. In percentage terms, it's not trivial, right? 99 down to 91, 8 out of 9, 9% in what, 2 days, 3 days? So what ends up happening is that, yeah, that's true. It has gone down. But if you see this volume compared to the size of the largest investors, it's just not that big. So now we've got this situation where this still will remain. But now let's just talk about the micro. So as I've said to people that, and it's not, is it kind of mocking? Yeah. I'm not going to, should I apologize? Yeah, I should probably apologize. I'm not going to, but, I should probably. That when people are talking about individual stocks or something like that, and I hear who it is and see what they do and that kind of thing, I'm like, okay, that's not how it works. Congratulations for you to get that spot. When it comes to Bitcoin on a intraday basis, what is going on is like absolutely off on a scale of 1 to 10 in terms of complexity. 19. So what is actually happening here? One of the inputs here is that what's going on here is that the barbarians at the gate, the actual smart guys in the room, the actual people sitting on the playing field who will change their minds hundreds of times a day, are pulling around Bitcoin in this erratic fashion. They've entered the playing field. This is Michael Saylor, who is the CEO of this company called MicroStrategy. And what are they doing? They're borrowing money to issue in the form of something called a convertible bond. There it is. They're using the money to buy Bitcoin. Now, when I say that the Acme Wealth Management is not part of the playing field? I'm going to give you the dummies version here. So you may know on Jay's Corner and other videos and things like that, I talk about the idea of replication. There it is. Right. Can I make minestrone soup? When actual Wall Street, the actual playing field, is doing this at high speed on every instrument all the time. The reason that merger and acquisition and these companies, slice out a $20,000, $20 million fee check per trade, per merger and acquisition transaction to Goldman Sachs and to Morgan Stanley, and why all these banks are chasing that business. The reason is because their recommendation is that they are doing something here with minestrone soup. Some ingredient inside of minestrone soup is too cheap and it's more valuable. Therefore, the minestrone soup is too cheap. Right? A plus B does not equal C. And given the fact that since what Wall Street is actually doing is they're running this replication exercise at high speed 24/7 around the planet. I can't stress this enough. It is not because, oh, well, Peloton has 1,000 more subscribers. Zero coupon bond. In other words, a zero coupon bond means you pay X, you get 100. So you're going to pay X today, and at some point in time, you're going to get 100. And and let's just call it 870. And let's say this is in 5 years. Right. So I'm not going to, so if I borrowed money from you today, I'm like, look, you're going to pay me, you're going to give me $100 today. I'm going to give you 100 in 5 years. Would you ever do this? If you would do this, please, J@gh2benefits.com. Oh, actually, send it in my private email. J@jwo.com, right? You would never do this because that you're giving me an interest-free loan. Don't do that. Don't do that unless that's your child, I guess. Right. But so the point is that, okay, let's say that I'm going to say, okay, I'm going to give you 100 at the end in 5 years. You wouldn't give them 100 today. You'd give them something lower. Let's call it 70. That also has a different terminology called a zero coupon bond, right? Because I'm not paying you any interest payments. I'm just going to pay you 100 at the end. That's inside here. What else is inside here? This stuff. Equity options. Sorry, it shouldn't be equity options. It should put plus options. Oh, no, equity options. And this is equity options on Monster stock. Okay. The main asset of Monster is, or the main factor changing value of Monster, of MicroStrategy, is Bitcoin. So now you can see the mechanism here. So this part, so we've got debates on each of these components. We don't, right? This is not Apple Computer with, $6 gazillion in the bank in cash, right? You're not lending money. You're not lending money to Jay's Rib Shack at the same level as you are to Apple Computer. Please don't do that. right? Obviously. And then you've got these equity options on this stock whose valuation is based on this asset, and that asset happens to be Bitcoin. And inside here, this options, not only that, but the options themselves depend on agreement of implied volatility. Now, what in the world is that? Implied volatility is the solved solution of the Black-Scholes formula. Solved. So you got a price, and then they're solving for the unknown parameter. For those of you who, right? Just look on the newsletter. There's a reason I'm sitting over here showing you this. Right? This formula over here is not new news to readers of the newsletter. You've seen this picture. You may have not known, and let's not get crazy, ND1 here is the standard normal distribution, which explains entirely the interconnectivity to start where you are, and then, of course, to this principle here. You got it. Very little to do with the narrative from Acme Wealth Management. Very little, as you can now see. And for people who have watched many, many videos and have their own more scientific backgrounds than I, which will be many, you can see it. I'm not introducing things here that you've not seen in other formats. You didn't know they existed, perhaps, but once seen, it's very difficult to unsee because it is entirely consistent with what you have known and known at levels better than I ever will. I'm very sure of that. The issue is so now you have now we have huge disagreement on implied volatility. And the reason is we don't have liquid markets. How to get the solved solution. And the net result, different hedge ratios. Of Bitcoin. You got it. We don't agree on how to hedge, so we don't agree on the option valuation. And the reason we don't agree is because we don't agree on the implied volatility, which is the solved solution here. Right? See this? Bloop. There it is. Right? In other words, you don't agree on the distribution of this, which is the input of this, of which this is the result. Because you don't have a way to get, there's no liquid market here to infer how this replication, right? In other words, if they had other options, if they have options on this kind of on this security for other dates, other 5-year dates, then fine. There can be some like eyeballing. You have none of that here. You have none of it. And so someone's assuming some implied volatilities at that point in time, and then what ends up happening is the hedge ratios, the result is they've got to hedge this stuff because they're still trying to hedge and get the replication. And the only way to do that is to trade around Bitcoin. Well, my point here, my takeaway to this is couple, right? This is way more complicated. You know, oh, well, I knew this was going to change the world, and so I bought it at, $100. You know, that doesn't explain anything about what is going on, right? Because this now here today is going on all the time during trading hours in New York or when the options market is open. And I see it. I see it. That, when we're looking at this grid, it doesn't change. It doesn't change certain things, right? By the way, right? I've had these conversations already. Time and date stamps matter. This is 3 years ago. I didn't pull down the ones that were wrong. Well, and actually, the reality is that, because these are on principles, the principles of finance are based on the science of estimation, which, it's just, which is different. And so this is way more complicated than you think. And then the question here, does this fit your strategy? That still remains. Then there's certain approaches, which is, can you have them all? Yes, you can. Right? You could be in multiple camps, which is, okay, I own at zero. It's now 100,000. Uh, I own 5 Bitcoin. Congratulations to you. It's $500,000. Well, now it's okay. How big is it part of your overall allocation? Because still over here, this is the case, right? That the number one driver of return here is your allocation. For people which is can be different, because then the question is, intraday. So tactically, it is wild because this is going on intraday. When I first saw this article, I knew this was going on as soon as I knew this was going on. But then what ends up happening is, if anything, what has happened as the prices increase, this activity here has increased in speed. There are more convertible bonds, etc. And now you can understand why when I said that Twitter has the professionals, that is absolutely true, and you can see. This person is like not the undereducated. This is expert in convertible bonds. Undisputed from the playing field. That conversation is way different than what you'll see at most. That you get conversations and commentary, expert commentary from people from the rafters. I'm giving you some information from the playing field and trying to get it so that people can understand, which is my task, of which we can debate how effective I am on that. Okay, that's all I've got for today. Thank you very much for joining. Again, please share. I keep it closed, right? Because this kind of video is not going to do well on the YouTube algorithm. It is not, right? How many topics have we talked about here? Right? YouTube wants to put you in a silo and said, here's your lane, stay in it. Who was that? Lonzo Ball's, stay in your lane, stick to sports. Yeah, the problem here is that when the sports are all, you can see that, yeah, the sport I have is that the world is giving information in very strange and inaccurate ways. If that's my sport, then I am sticking to sports. All right, everyone. Have a good weekend. Thank you.